let's get started talking about Fibonacci levels. Okay, now, if you notice on your screen, I've put together some special handouts for you. There's the Fibonacci Retracement Guide, the Introduction to Technical Analysis from investing.com, and you can click those little download buttons. There's nothing you have to do. Just click the download buttons. They'll be downloaded directly to your device, and then you can move them around later because they're only available in the live class. Also, there's just a little document that says presentation YouTube link. Tonight in this class, I have a couple little tiny short presentations I prepared for you because it's easier to have the creative department prepare these and get them ready for you. And if you wish to see them, they're not re-recorded in the recorded version of the webinar. So you can use those by going to that link in that presentation file I gave you. Or if you go to YouTube and look for the channel called Trading Education, and then look under the playlist for Fibonacci, and you'll be able to see these little recorded versions. So also remember, these handouts are only available during the live class. You cannot get them in the recorded version. Now, in tonight's class, I'm going to use the term security, but I might say Facebook, I might say Google, I might say the euro. But I'm not talking about a specific asset. I'm talking about generally any asset that's publicly traded that has an open market, because the Fibonacci can be applied to any of these. Now, similarly, I intermix the terms investing and trading. Now, we're all here because we're basically traders. We know the difference. I know the difference. You know the difference. But it gets very, very boring saying trading, 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 trading. So I intermix the terms. But investors very rarely use technical analysis because they're trading for the long term. They're looking for, what the long-term goal is, what the long-term value of a stock or an asset might be. But we're traders. We're looking for short term. And this comes to us through technical analysis. Now, people ask me all the time, should I buy today? Should I sell today? What will the price be an hour from now? Or what will the price be tomorrow or next week or next year? Well, wouldn't investing and trading be easy if all of us knew those answers? But you know what? I don't have those answers because I don't have a crystal ball or a Ouija board, and neither does anybody else. So anybody who tells you they can tell you where the price will be at the end of today or later today or tomorrow, they're full of it. We can use strategies. We can use analysis to predict where price might be going or where it should be. But none of us can say that the euro is going to close today or close at 4 o'clock at 113.47 because price is completely random. Now, there are times that prices are small frequencies that price is trading in a non-random movement, and we'd like to identify those. And when price is trading non-randomly, we can actually make very good trading decisions. So if you're attending this webinar with the hopes that technical analysis will improve your investing and trading, I've got good news for you. It will. Have Fibs, or Fibonacci retracement levels, will really help you. So Fibonacci retracements are ratios used to identify potential reversal levels. These ratios are found in the Fibonacci sequence. Okay, now, I don't know how many of you know the history and the background of Fibonacci, and we're not going to go on to that deeply at all. All I can tell you is the Fibonacci ratios and the Fibonacci sequence, or the Fibonacci sequence, it's been around since the 13th century. 13th century, we barely had currency. If we sure didn't have online trading, we didn't even have the stock market then. So we didn't have financial markets. So fibs were around for hundreds of years before they were ever applied to the financial markets. But Fibonacci retracements are the 61.8 and the 38.2. These are retracement levels. Basically, it says when an asset is moved a specific movement up, it will tend to retrace 38.2% of its prior move or 61.8. Now, a lot of us, including the Fibonacci tool, uses 50%. 50% has nothing to do with Fibonacci retracement levels. 50% comes from Dow theory. But it's such a popular retracement level that it's been added into the Fibonacci tool. Now, these retracements can be combined with other indicators and price patterns to create an overall strategy. But how do we take something that was developed in the 13th century or the 12th century and apply it to online financial trading? Well, before we can even get to that point, we need to understand what or where fibs came from. Now, the Fibonacci sequence is where it all started. I'm not going to go back and tell you how it was developed, but it's a very easy sequence. You can duplicate it easily yourself. You don't have to memorize anything. It always starts with a 0. And the fib numbers are always the same. Start with a 0, and you add the 0. Summer and air conditioning, I'm sorry. You add the 0 to a 1, and you add those 0 and the 1 together, and what do you get? You get a 1. You then add the 1 to the previous one, and you get a 2. You go back and add the 2 to the previous number, which was the 1, and you get a 3. You add the 3 to the previous number, which was the 2, and you get a 5. You add the 5 to the previous number, and you get an 8. You add the 8 to the previous number, which was the 5, and you get 13. This is the Fibonacci sequence, and it goes on for eternity. Now, nobody memorizes these numbers. They're not like square roots. They're just a Fibonacci sequence, and you can duplicate them by doing just like that. But could I tell you what the Fibonacci number is, 30 numbers down the road? No, I could look it up on the computer, or I could calculate it, but nobody really cares what the 30th Fibonacci number is. We just know this is how the sequence goes. Now, how would we apply this, or why would this make any sense to the financial markets? Okay, so we need to find some way, first of all, to convert the sequence into ratios. Now, the sequence extends to infinity and contains many unique mathematical properties. Now, the Fibonacci ratios that we talked about, again, weren't developed for the financial markets, but these ratios can be found all throughout history, through architecture, through the galaxy, through, well, it even explains the ratio between our eyes, our ears, our nose, and our mouth. Now, remembering what the Fibonacci sequence was, 1 plus 2 equals 3. 2 plus 3 equals 5. 3 plus 5 equals 8. Add the 3 to the 2, you get 5. Add the 5 to the 8, and you get 13, so on and so on. So this is the sequence. Okay. Now, if we were to take these numbers in the sequence and take 21, it doesn't matter where you start in the sequence, you take the equal number and take the previous number. So we had the 8 and the 13, and it equals 21. Okay, if we were to take that 21 and divide it by its previous number, which was 13, it's always going to be, depends on how many digits you take it out to, 1.618. Whether we go out farther and take the 34 and divide it by the 21, or we take the 5 and divide it by the 3, it's always going to be 1.618. So we say the approximation near is 1.618 as these numbers increase. So this is part of the Fibonacci ratio. If we were to go one step farther and take the 13, and we're going to reverse this sequence. We take the 13 and divide it by the 21. We're going to get 0.619. If we were to go one step farther and take the 21 into 34, we get 0.6176. If we were to go back here and just take the 5 and divide it by 3, we would get, or the 3 and divide it by 5, I'm sorry, we would get 617 or 618. So the approximation always nears 0.618. So this is the basis of the 61.8% retracement. The 61.8 number in the sequence, which is then being converted to a ratio. If we go one step farther than that, and we were to take the same 13 and divide it by the 13 plus the 21, which gave us 34, that number will always give us 0.382, or it might give us 0.3818, but the approximation will always be 0.382. This 382 becomes the next ratio in the Fibonacci ratios. Now, you can also take, if we would have taken number 1, and subtracted the 61.8, guess what? That would have given you the 38.2 also. Now, we could go one step farther and take the 13 and then divide it by the 13 plus the 34, which was, I'm sorry, we divided by the 21 plus the 34, which was 55. And that would give us the next Fibonacci ratio, which would be 0.2360. And you can keep doing this, separating the numbers farther and farther apart to get lots of ranges or lots of ratios. The primary ratios we're concerned with is 0.6180, and that's known as a Fibonacci extension because it is beyond the 100% level. And then we have the retracement levels, which are 61.8 and 382, which are the most popular. And then that's combined, like I said before, with 50%. Now, the 1.618 refers to the golden ratio or the golden mean, which is also sometimes called phi. The inverse of the 161.8 is 618. Now, these ratios can be found in everything from the back of the shape of playing cards to the Parthenon to the shape of sunflowers to, and the shape of on the back of a snail shell to Greek vases and spirals in the galaxy. So like I said, it wasn't developed for the financial markets. Now, someone started applying these levels to the financial markets a long time ago. And they found that when an asset moved either up or down, it would retrace the 38.2% of its prior move. So in other words, if the asset had fallen this far, you can calculate that, and when it makes a retracement, it's either going to fall to 38.2% of that prior move, 50% of that prior move, or 61.8 of that prior move. So an asset will often pull back or retrace a percentage of the previous move before reversing. These Fibonacci retracements often occur at 3 levels, 38.2, 50, and 61.8. And actually, the 50% level does not have anything to do with Fibonacci, but traders use this level because of the tendency of assets to reverse after retracing half of the previous move. So before we talk about actually interpreting Fibonacci, we have to learn how to put it on a chart and where it comes from, because you're measuring the prior move, not the current move. Okay, so in order to find these Fibonacci retracement levels, you have to find the recent significant swing highs and swing lows. So then for a downtrend, we click on the swing high and drag the tool to the swing low. For uptrends, we do the opposite. So let me see if I can show you this in a little presentation. And then we'll go look at a live chart and see if we can put this on there.
Mathematical equations and strategies out there that try to make sense of a market that is largely speculative. However, it is widely accepted among traders that rely on technical analysis that most major moves will retrace around the Fibonacci levels, and more specifically around the 50% level of the move. So in an uptrend, a price will retrace down a certain percentage of the move before continuing its long upward movement. Likewise, in a downward trend, the price will move up a certain percentage before continuing its long-term downward movement. If the price moves beyond the 50% level, it might be a signal a trend reversal is about to happen, and it may be an opportune moment for switching the direction of your next trade. In this tutorial, we will simply refer to the Fibonacci Retracement tool and how to use it. We will be explaining the mathematics and more on Fibonacci in following video tutorials. So traders use these Fibonacci levels as efficient entries in the direction of the trend because many traders watch these same levels and place buy, sell or stop orders based on them. They are quite accurate and become a self-fulfilling prophecy. So how should you enter in an uptrend? You can use the Fibonacci retracement levels for an entry into the market. For an entry in an uptrend, you should look to see whether the price finds support at these levels. Then we suggest you wait for confirmation that the price will move back into the original upward movement and then enter. As with any technical indicator, it is better to seek additional indications to support your initial analysis so that you don't base your trade solely on Fibonacci retracements. Look for clear signals to buy or sell. For instance, wait for a candlestick to close in the desired direction to give you more confirmation on whether you should place an order. If it does form, you can place a market order at this point as you have solid reasons to believe that this level could hold. How to enter in a downtrend. Likewise, for a downward trend, you can place your entry after the price has found resistance at one of the Fibonacci levels. After you wait for confirmation that the price will move back into the original downward trend, you can place your entry order. So how to place your exit. Now that you have decided on your entry, you need to determine your exit strategy. Your exit strategy is comprised of two steps. First one is deciding where to place your stop loss, and the second is where to place your target profit. Let's look at the same graph that we had for our upward trend. Here we suggest you place your stop loss just below the retracement level. In a downward trend, we suggest you place your stop loss just above the retracement level. Where should you take profit? And now for the best part, your target profit. If we use Fibonacci retracement levels to forecast entries into the market, we can use Fibonacci extensions as reasonable profit targets. Fibonacci extensions make good potential take-profit levels for trades in the direction of the trend. Similar to the retracement levels, the key Fibonacci extension levels are 38.2%, 50%, 61.8%, as well as 100, 138.2% and 161.8% extension levels. The Fibonacci extensions correspond to retracement levels, making it all very simple. If you enter at 50 or 61.8%, a good take profit is the corresponding extension level at 161.8%. Let's go to the Trading 212 Pro platform to demonstrate how to use the Fibonacci retracement tool. Here we have opened the chart for the German index DAX in a candlestick mode at a 1-hour time interval. The price's movement is easily recognizable. In the Trading 212 platform, on the side you have a Fibonacci icon. When you click it, you choose retracements. Then you click right where the trend begins and drag until you reach the end of the movement. Where the move started, you'll see a 100 displayed on the side, and where it ends, a 0. When you have plotted this line, the Fibonacci tool automatically places the retracement levels based on the Fibonacci number sequence. In our case here, you see a retracement at 38.2%, and we would enter at this level. We would then place our stop below the entry level. You could place it either below the 50% or the 61.8% level. We will take the first Fibonacci extension level at 61.8% as a reasonable target profit. To summarize, A retracement is a short-term price correction during an overall long-term upward or downward trend. The benefit to trading retracements is that they provide an opportunity to profit by entering a trade in the original direction of the trend at a better price. The basis of the trading strategy is to buy pullbacks in an uptrend and sell rallies in a downtrend. A good way of identifying them is to use Fibonacci retracements.
Let's go over and look at a live chart and see how, let's do it step by step. So in order to apply Fibonacci levels to your chart, you need to identify swing highs and swing lows. Now, some ways you can do it is to find a swing high is a candlestick with at least two lower highs on both sides, right and left of itself. A swing low is a candlestick with at least two higher lows on both left and right side. I look for what I call the significant swing high and swing low, not the lowest point or the highest point the price has reached, where we could see a significant move at that low or that high. Okay. When using Fibonacci tool, the probability of Forex trading success could increase when used with other support and resistance levels, trend lines, and candlestick patterns for spotting entry and stop loss points. Now, when we looked at moving from the Fibonacci sequence to the Fibonacci ratio, and we calculated those 13s plus 15s plus 21s and divided them, and we came up with approximately 619, 6186, 6179. Remember, they were all then put together and came out to the 6182 level, the 618 and the 382 level. So remember, those levels are not hardcore numbers. We use 61.8 and 38.2 as the numbers we use. But remember, they're not giving you exact buy and sell because they're not exact numbers. They were approximations. So keep that in mind. That's why you need to use other tools. So let's go over to a chart. And we're going to go look at the Euro US dollar chart. And here we have the Euro US dollar chart, 30-minute chart. We can see the Euro US dollar has been trending straight upward. That trend is now edged down and is now reversed and started moving in a downtrend. So we would locate the Fibonacci drawing tool and go to Fibonacci retracements, click it on here. And what we're looking for is a significant swing low. Okay, well, we can see that this price right here is that significant swing low because the price came down to this low, touched off, bounced off, came up, and then hit it again, and then started reversed completely. And we need to find the significant swing high, which is this high right, let me just put a marker on here. This high right here. Just look at it, it's very clear that was the significant high. Okay, bounced up, hit that level, bounced off of it. Now, we have a lot of choices with the Fibonacci tool. And if you notice, because remember I told you when we were looking at it, you can do all types of calculations. Okay, you can keep moving the numbers farther apart and keep dividing them. Okay, 23.6 is an important Fibonacci level. It's called a shallow retracement, but for us in Forex trading or online trading, CFD trading, it is an important level. The zero is important. 38.2, the 50% and 61.8. I don't use the 76.4 and I don't, 78.6 is also an important level. And I'm going to show you a strategy using 78.6. This 161.8 is the extension. Anything over the 161 are all extension levels. So we're not looking at those right now on our tool. We can also set the colors we want to see and set everything up that fits what we want. And what we have over here now is our Fibonacci tool. We can see the zero here, the 100's down here where we started from. Actually, let's put the 100 back on my okay, for some reason it won't give me the 100 level, but we have the, oh, it did, it gives me the circle. So we have, then we have the 78.6, the 61.8, the 50% retracement, the 38.2, and the 23.6. Now, we can see that price now has reversed from that highs low. Where has it come down to? Look how important that this 23.6 level is. Price is sitting right on that 23.6 level, came down and bounced off. Okay. So that became an important level. So we have been looking at this asset, saw it moving in a downtrend, and we're looking to buy to continue that uptrend. We would take a look at, might be considering re-entering the market because it's going to go up. But we can't make that decision with a single tool. But look how important this level was to that decision making. Okay, so let's go back to my PowerPoint and see now that we're getting these on our tools, how we can actually use these to make trading decisions. So remember, these are alert zones because retracement levels alert traders and investors of potential trend reversals. And retracements are based on the prior move. A bounce is expected to retrace a portion of the prior decline, while a correction is expected to retrace a portion of its prior advance. Once a pullback starts, chartists can identify specific Fibonacci retracement levels for monitoring. Now keep in mind these retracement levels are not hard reversal points. Instead, they serve as alert zones for a potential reversal. It is at this point that traders should employ other aspects of technical analysis to identify or confirm reversals. So let's talk about how we would use these in the real world to make trade.
Look at Fibonacci in the real world. What we're looking at is gold. So I'm going to do a couple of historical examples to show how it might have worked, and then a current example on gold. So let's pretend it's the end of February. So we're here. We've watched gold go from these December lows around about $1,120 an ounce, up as high as here, up as high as sort of 1260 area recently. And it starts to come off. So we think, right, I'm going to use my Fibonacci retracements to try and figure out where the price of gold might stop sliding and bounce and continue this trend. So let's put the retracements on. So we pick them up from here. We start at the beginning of the move. So I click down there and then drag it all the way up to the high. And it puts the retracements on for me. Let me just adjust this one down here. There we go, that's better. Like a lot of software, it does include some additional Fibonacci levels, but the main ones I'm worried about, let me just make this a bit clearer. I'll right click, change the color, make the lines a bit thicker. Here we go. So what I'm looking at is the 23.6, the 38.2, the 50, and the 61.8. So if the Fibonacci is going to work, the market's gone up, and then we're looking to see if these levels, the 23.6, the 38.2, the 50, and the 61.8, do they support the market? Let's just walk through and see what happens next. So these are daily candles, don't forget. So the market's selling off. So we're on the 23.6 level now. That's broken, it's gone through that. So the next one to watch for support is the 38.2 at 1209. That's gone again. We can see it breaking through. And the next level we're looking at is 50%. So the market's gone from here up to there. And now if it gets to this level, it's dropped back 50%. That's our next Fibonacci level. So let's just push it forward. And actually, it looks like it's working. So the market went from X to Y, dropped back 50%, and the market has recovered. Let's have a look at the next rise. What happened next after this? The market did push higher up to here, just back up near that old high and started coming off again. So again, let's, as usual, let's just adjust our lines. So we'll pick it off that high there. And again, we're just trying to see now what happens. Does the market hold on these old levels? I think it's pushed just a little bit higher. So let's just nudge it up to that high up there. There we go. And it started coming off. So our 23.6% level is at 12.54 an ounce on gold. Then we've got 1228.5. That's our 38% retracement, and then the 50% is there at 1208, and then the 61.8% is there at 1187. So let's just walk through and see what happens next. The market's sliding, so it's taking out that 23.6% level. So 38.2, that's the next level to watch. It's taken that out, but so far it's holding, and once again the 50% retracement level has worked. So it took out the first two Fibonacci levels, but the market did move higher again. Okay, so now this is an up-to-date chart for gold up until the end of last week. So the market had pushed higher beginning of June, sold off. Let's put our Fibonacci levels on. Let's take them again. Let's take them again from the start, from down here. So from those lows in December up to the most recent high, beginning of June. Again, I'll right-click, make this a different color so we can see it. There we go. So the market slid off, has slid below 23.6. At the moment, it is holding above that 38.2% retracement at 1230-ish level. And if that level breaks, the 50% one to watch out for is 1210. So there might be a couple of levels, if you're a fan of Fibonacci, to keep an eye on for gold in the days to come.
Talk about a couple ways that we can use fibs in our strategy as opposed to just seeing our retracements. So one of the more popular strategies is called the triple fib strategy. So if you're a trend trader like me, you typically don't like to see sideways market conditions on the 4-hour daily charts. But there are some strategies that can work effectively within those type of market conditions. The triple fib strategy is one of them. So first, it's meant for sideways markets. There are many ways to define sideways conditions, but the easiest way is to simply eye test on the 4-hour of the daily chart. If there are lots of candles, but the price hasn't changed much, you're probably looking at a sideways market. Basically, if you can spot and define a top and a bottom within the last few weeks, few months, or even the last few hours, depending on what hour time frame you're looking at, we might consider a sideways market condition stable. So here's an example. You can see I've highlighted the big top and the big bottom, the bigger arrows right here. And within that range, there are many other tops and bottoms. So if you be an opportunity to employ the triple fib strategy, it's a very basic approach that allows you to take advantage of a sideways market without having to have perfect timing. After finding a suitable market, then we want to zoom into the 30 or the 60-minute chart. Either time frame is suitable, but I prefer the 30-minute as it gives me a slightly more detailed look at the price action involved. Moving to the 30-minute chart, in the example, and we see the 30-minute chart, here's what we see. Third, identify an impulse move within the sideways range. What we're looking for is at any type of quick price action movement. And of course, since I'm using this as my example, we have one here. The idea is that the market is moving, is very churning measured moves. So when we see a spike like this, it is very likely that we'll get a retracement. Seeing this spike right here? This sets up a great opportunity to buy into the in the retracement because we know it's unlikely to plunge beyond the lows. But there's one problem when it comes to buying a retracement: timing. No one knows how long the retracement will last, so it's difficult to know when you should begin jumping into the position, even if you're confident it's going to move up. Getting the direction right is only half the battle. That's why I like the triple fib method. I use fib levels to set up this entire trade so that I can make money without perfect timing. So fourth, we set up our trade. Setting up this trade is really easy. All you need to do is use the fib tool to draw a retracement from the bottom of the spike to the top of the spike. From here to here. Then you split your position size into 3 separate units, hence the triple, and place 1 unit at the 38.2, 1 unit at the 50, and 1 at the 68.2 with a stop loss below the 78.6 and a target at the 23.6. So in this example, here we have the spike. We've set our fib line based on only the spike, not the trend line, but the spike. And then in this example, you can see that we have taken into the first 2 entries and then hit the take profit without taking the 3rd position, because we weren't able to take that 3rd position because it hadn't reached there, but we made the profit. It's probably easier to see visually, so let me give you the hindsight version of this last trade. Okay, so here you can see it after it's actually all happened. Now, there's another trade or another strategy that you can base on what we call the 78.6. This is an important number, although it's neglected often. So imagine yourself in a store and the salesperson all of a sudden says, all of our goods are available at 78% discount. Guess what? Buyers step up at least some of them. Buyers that weren't interested in buying anything, all of a sudden they're grabbing up. The same principle can be used in the world of Forex trading. This simple market psychology is valid for all financial markets as well, and if you know how to apply the fib tool correctly. So the importance of 78.6. Fib levels give traders an opportunity to join a trend at a discount and ride the continuation of the trend. Have you ever heard the expression, sell the rallies and buy the dips? Fibonacci traders can combine the 88.6, which is really too steep for CFD trading, and the 78.6 Fibonacci retracement to highlight a hotspot or trading zone where probability trades are more likely to take place. Indeed, the zone between the 78.6 and the 88.6 Fibonacci retracement is a hot spot trading zone. New research on this subject claims that the golden ratio 1.618 can be applied not only to mathematics, but to physics, chemistry, biology, and typically, to science everywhere. Also applies to deep retracements of using this 78.6. In times of high volatility trading, the price tends to respect the 78.6 to a great extent. There is a connection. This is why the 78.6 are extremely important in buy trading. Remember, price action in Forex repeats itself. That's a unique advantage in the Forex markets. So let's take a look at what we're talking about. Now, it's very rare that an asset's going to hit that 78.6, but too many traders overlook it. When they see it fall past down to 38.6, down to 50, 78.6, they've already say it's a reversal, it's over and done, and it's not a retracement. But 78.6 can be very, very important. So let's take a look at how you could, when you see the 78.6 hit, what you can.
In this situation that we see, forgive my terrible drawing of these candles, but we see that the market came up, retraced down to this swing low, and then we broke above the most previous structure level here. And since we broke above and closed above this most previous resistance level, our expectation would be a continuation of bullish momentum, a continuation to the upside, before a break below the most previous swing low right here. So what we expect this market to do is to go up further before it comes down and breaks below this most previous swing low. And the way we take advantage of this using this trading strategy is after we get a break above, close above the most previous resistance level right here. After we get a break above, close above this level, we take a Fibonacci retracement from our swing low right here up to the highest swing high before the market starts to retrace. And all we do is wait for a 786 retracement. As I said before, very, very simple, yet very, very effective strategy. The reason we wait for this 786 retracement is because we expect the market to continue bullish before breaking below this swing low. So what that means is if we wait for a 786 retracement, we can put our targets back up at previous structure because we expect the continuation of the bullish trend, and we can put stops down here below the most previous swing low just in case we're wrong, because if we are, we want to get out for minimum losses if we're wrong, and we have an opportunity for a very nice gain. And I hope that makes sense. If it doesn't, then leave me a comment and ask any questions you might have, and I'll try to answer them best I can in the comment section below this video. I'm going to now go to the charts and show you a few examples on the dollar yen that we took advantage of over the past couple of weeks. And then I will show you a live example of this trading strategy on the Euro Aussie 15-minute chart. Alright, so here we are on the dollar yen, and I'm just going to start right here in a random position on the chart and show you a few examples of the trend continuation 786 strategy. So what we look for first is a break above, close above, or break below, close below of a previous structure level. Here is our previous resistance level. We obviously break above and close above it right here. Since we broke above and closed above that level, what I would do is, if this market had not already played out, if this was all to the left and I had no right into my chart, what I would do in this situation is take a Fibonacci retracement from swing low to swing high and wait for the 786 retracement right here. And as we can see, the market rallied before ever getting close to the 786, which is fine. That will happen a lot. And next off, let's continue on the chart. As you can see, we get another break above, close above this previous resistance level right here. On this candle, we break above, close above this level. So what I would do is take a Fibonacci retracement from this swing low, the most previous swing low here, up to the swing high before we start to really retrace. And as you can see, we came down here to the 786, would have been filled on this order, and we would have hit targets there, coming up to this previous resistance level, which is where our targets would have been, and our stops would have been below our most previous swing low. This would have came down and put us through a little bit of pain on this wick right here, but we would not have got stopped out on that trade. And we just continue down the charts doing this same thing. Right here, break above, close above this level. So now we're looking at this most previous swing low right here. So we come from this swing low up to the swing high before it starts to retrace. We would have bought the 786 right here on this candle wick, and we would have been stopped out of this trade. But look here, look what happens now. Now we have, instead of breaking again to the upside, now we have broke through this support level, and this support level. What that tells me is bearish rotation. Now that we've broke down below these support levels, I'm in a bearish trend mindset. With that being the case, I'm going to now take a Fibonacci retracement from this swing high down to the swing low and look for my same 786 retracement. As you can see, would have been filled here, and this is a trade we actually took advantage of. We were filled there, and the market eventually rolled over and did hit targets. So I hope that helps you to better understand the 786 strategy. As I said before, leave me a comment if there's something you don't get about this strategy, and I'll try my best to answer it in the comment section below this video. I'll now be showing you a live example on the Euro Aussie 15-minute chart. Okay, so here we are on the Euro Aussie, awaiting the completion of the 786 strategy that I was talking about. And pretty much all we're doing here is waiting for a break below, close below of the previous structure, and then putting a limit order at the 786 Fibonacci retracement, a stop loss above your previous swing high, and profit targets at the lowest body of the previous swing low. And there we go, we're filled, and I will keep you updated on how this trade plays out. And as you can see, guys, we've come up into our 786 retracement here and immediately turned around. We've now made it about halfway to targets, so we'll see how this plays out, and I'll be back to update you. Alright, here we go. So we've gotten within about 5 pips of our targets here, and when we get down here within 3 pips, I'm going to move stop losses to break even so that we can be in a risk-free trade, and hopefully we'll see this market continue down. As you can see, we've made a lower high here, and then we put in a very long bearish candle so far, and this candle has 15 seconds before it closes. If we can get under these lows right here with this candle, then our stop losses can be moved down to break even. So now we've got within 3 pips of our profit here. What I'm going to do is take my stop loss, bring it down here to break even, and take all the risk off the table on this trade. So this is now a risk-free trade.
So there are many ways that we can use Fibonacci in our trading. Fibonacci retracements are often used to identify the end of a correction or a counter trend bounce. While a short 23.6 retracements do occur, this 38.2 to 61.8 cover the most possibilities with 50% in the middle. Now 786 is a very steep retracement, and that's why it gives us a great trading opportunity when that does occur. Now this zone may seem big, but it's just a reversal alert zone. Other technical signals are needed to confirm a reversal. Reversals can be confirmed with candlesticks, momentum indicators, volume, or chart patterns. In fact, the more confirming factors, the more robust the signal. Well, I hope that gives you some idea of how to combine Fibonacci into your trading or to combine Fibs into a trading strategy. Thank you very much for joining us tonight. And if you do have any questions, contact ubcfx.com. And if you do, just go to their comments and send them a message with any questions you have, and they'll be glad to answer them for you. Thank you very much, and thank you for supporting UBCFX as well as investing.com. Have a great trading night. Bye now.